what are the determinants of option value? What I'd like to do is to go through the 6 major things that influence the price of call options and put options. What I'll do is I'll go through each determinant and talk about calls and then talk about puts. And I'll try to present this with as much intuition as possible. Let's first consider the call option. And the first determinant of the value of the call option is the underlying stock price. If I've got a call option to purchase 100 shares of IBM at $200 and the current price is $200, what happens if the price of the underlying IBM shares increase, let's say to $210? Well, this makes my option more valuable. It increases the probability that at the end of the option's life, the option will be in the money. In the money meaning the underlying asset price finishing above the exercise price. So anytime the underlying commodity price goes up, it benefits the price of a call option. Now, what about a put option? Remember that a call option, you're betting on the price of the underlying commodity to go up. With a put option, you're betting on the price of the underlying commodity going down. Now, if the price goes up, this is bad news for the put option. Suppose we have a put option with an exercise price of $190 and the current stock price is $200. If the price goes from $200 to $210, this is clearly bad news for the put option. It decreases the probability that the underlying stock price will be below $190 at the end of the option's life. So an increase in the value of the underlying commodity decreases the value of the put option. Now the next determinant of option value, let's consider the exercise price. And one thing that you could actually do is to open the Financial Times or the Wall Street Journal and look at a series of option prices. For example, let's look at IBM, for example. Look at a stock that has got a lot of option trading, not a stock that has maybe 1 or 2 options. And you'll notice that the option will be organized by call or by put. They'll have a number of different strike prices. And they will have a number of different expirations. So now let's think about the exercise price. Now, suppose that we've got options, and one of them is on IBM. The current price is $200, and the exercise price is, let's say, $200 also. And suppose there's another option, and the exercise price here is, let's say, $220. Which option is more valuable? Well, let's think about it. If the call option for the exercise price of $200, it will be valuable if the final price of IBM finishes above $200. And given that the price of IBM today is $200, there's a fairly high probability that we'll finish in the money. What about the $220? Well, this option will only be valuable if the stock price climbs above $220. It's clearly less likely that the stock price will be above $220 than above $200. Hence, the call option with the exercise price of 200 will be more valuable than the call option with the exercise price of 220. Another way of looking at this is that the option gives you the right to buy the stock. It's obviously most valuable when you've got the right to buy at the cheapest possible price. So you prefer to buy at a lower price. What about the put option? You can probably guess that we have the opposite effect for the put option. So let's think about it. The put option in our example, we had the right to sell at $190, 100 shares of IBM, and the current stock price is 200. Now suppose there's another option, another put option, that gives us the right to sell 100 shares of IBM at, say, $210. Well, which one is more valuable? For the 190 exercise price, the price of IBM has to finish below $190 for this option to be valuable. For the 210 exercise price, the price of IBM has to finish at 210 and below. Which is more likely? Well, it's more likely that it's going to be 210 and below. And actually right now, the stock is trading for 200. So the put option becomes more valuable when the exercise price is higher. And again, we could use the same type of intuition. If you've got the right to sell, you would prefer to sell at the highest possible price. So hence an increase in the price that we agree to for exercise will increase the value of the put. Again, I encourage you to open the paper or to go to the internet and take a look at some quotations to make sure that you see that these line up. Now the third determinant of option value is the volatility of the underlying commodity returns. Now, what does this mean? If there's high volatility in the underlying commodity, then there's a high probability of a big move up, and there's also a high probability of a big move down. Now, if I have a call option, if we move down in a big way, then I just walk away and I take a loss equaling what I paid for the call option. But if there's a big move up, I stand to profit in a large way. So if we look at two securities, one with a fairly low volatility and one with a fairly high volatility, the value of the call option is going to be higher for the security with the high volatility. The intuition is simple. It means that there's a bigger chance of a big payoff. So increases in volatility will increase the price of the call option.